Shah Gilani claims to know Trump trade war stocks that will boom on June 17th, and I reveal the stocks in this video so you don't have to buy Shah's newsletter. Just keep in mind no paid or proprietary info is given away here, and it's guesswork based on the clues in Shah's publicly available sales presentation. There's multiple stocks to uncover, so we're just going to jump right into things. The first stock has to do with rare earth metals. Shah makes the claim that America has essentially relied solely on China for rare earth metals despite having plenty here in the States. Shah claims Trump is going to build a massive rare earth industry in America, and one company in particular is going to make this happen. Here's the quote Shah leaves that allowed me to figure out the stock. They just opened a new state-of-the-art facility for rare earth metal, alloy, and magnet manufacturing in the United States. In short, they are building the rare earth supply chain in the United States. I believe this company is likely to sign massive supply contracts with companies that must have access to rare earths like Apple, Tesla, Nvidia, and more going forward. And finally, Shah says, in fact, they already signed a massive strategic partnership with General Motors, and more of these deals are likely to flow in during the days ahead. This stock is MP Materials and the ticker is MP. MP Materials is a US-based company specializing in the production of rare earth materials essential for advanced technologies such as electric vehicles, renewable energy systems, robotics, and defense applications. Headquartered in Las Vegas, Nevada, the company owns and operates the Mountain Pass mine in California, the only active and scaled rare earth mining and processing facility in the United States. MP Materials has entered into a long-term agreement with General Motors to supply rare earth materials for EV motors, supporting GM's North American EV production. Additionally, the company has received substantial backing from the U.S. government, including a $35 million contract from the Department of Defense to develop a facility for processing heavy rare earth elements, enhancing domestic supply chain resilience. I think this stock belongs on a watch list and isn't quite a buy yet. Here's the top 5 reasons I feel this way. First is from mine to magnet, MP's full circle strategy. MP Materials is the only US-based company that spans the entire rare earth supply chain, from mining at the Mountain Pass facility in California to producing finished magnets. This vertical integration positions them uniquely to capitalize on domestic demand for rare earth elements, especially as the US seeks to reduce reliance on foreign sources. Second is geopolitical tensions shine spotlight on domestic producers. With China's recent export restrictions on rare earth elements, the US is emphasizing the need for domestic production. MP Materials stands to benefit from this shift, as it's poised to fill the gap left by reduced Chinese exports. Second is strategic partnerships bolster MP's market position. MP has secured significant partnerships, including a long-term agreement with General Motors to supply rare earth materials for electric vehicle motors. Such collaborations not only provide revenue stability, but also enhance MP's credibility in the industry. Fourth is financial show growth, but profitability remains elusive. In the first quarter of 2025, MP Materials reported a 25% year-over-year revenue increase to $60.8 million. However, the company posted a net loss of $22.65 million, highlighting ongoing challenges in achieving profitability. Fifth is analyst sentiment, cautiously optimistic. Analysts have a moderate buy rating on MP, with a 12-month price target averaging $23.61. While this suggests potential upside, the company's current financial challenges warrant a cautious approach. The next stock Shah is pitching is in the American steel sector. Here's the clue Shah leaves us for the stock. It's a company that provides the essential metallurgic coal that is needed for steel production in America. They operate 17 production facilities in total, with U.S. operations ranging from Wyoming and Colorado to Indiana and Illinois, down to Alabama in the South. The company produced approximately 115 million tons last year. This stock is Peabody Energy and the ticker is BTU. Peabody Energy is a leading global coal producer headquartered in St. Louis. Founded in 1883, the company operates both surface and underground mines across the United States and Australia, supplying coal primarily for electricity generation and steel production. Peabody's operations are organized into several key segments like seaborne metallurgical, seaborne thermal, Powder River Basin, and more. The company serves customers in over 25 countries, emphasizing its global reach. This is another borderline buy to me, and here's why. First is met coal momentum, riding the steelmaking wave. Peabody is shifting focus to metallurgical met coal, essential for steel production. With the Centurion mine back online and a $3.8 billion acquisition from Anglo American, Peabody aims to triple its met coal output by 2026, tapping into Asia's robust demand. Second is thermal coal turbulence, navigating price pressures. Thermal coal prices have plummeted to a 4-year low due to global oversupply, especially from China. This downturn affects Peabody's thermal coal segment, which still comprises a significant portion of its revenue. Third is financial fortitude. Solid Q1 performance amid challenges. In the first quarter of 2025, Peabody reported $937 million in revenue and a net income of $34.4 million. While these figures are down from the previous year, they demonstrate resilience amidst market headwinds. Fourth is analyst optimism. Bullish forecasts ahead. Analysts project BTU's stock price could reach between $22.35 and $29.96 by July 2025, suggesting potential gains exceeding 100% from current levels. The consensus rating is a strong buy, reflecting confidence in Peabody's strategic direction. Fifth is strategic shift, embracing a cleaner future. Peabody is investing in sustainability, including a 5-megawatt power station utilizing waste gas from coal seams. This move indicates a commitment to reducing environmental impact and adapting to evolving energy landscapes. The last stock has nothing to do with natural resources and instead is an undervalued AI stock, according to Shah. Here's some clues Shah left us for this stock. He says, it trades for around $10, earnings have jumped by 52% year over year, and the company is loaded with cash, $1.6 billion versus just $77 million in debt. And finally, Shah says, they've created something called agentic AI systems that help businesses ramp up production through the use of AI. You can think of agentic AI as the brains behind technologies like autonomous vehicles, robotics, shipping automation, drug discovery, optimizing supply chains, and more. The company's partner list included the biggest and most powerful companies in the world: Amazon, Microsoft, Google, Wells Fargo, Merck, Oracle, Salesforce, Adobe, IBM. The list goes on and on. This is UiPath, ticker PATH. UiPath is a leading global company specializing in robotic process automation. UiPath's platform includes solutions for automating workflows, AI-based document processing, and process mining to identify and optimize automation opportunities. UiPath has been pitched a lot over the last 2 years and always disappoints. I don't think it's worth investing in, and here's why. First is growth engine stalling, revenue deceleration ahead. UiPath's revenue growth has been slowing, with fiscal Q4 2025 showing only a 5% year-over-year increase, down from 10% in Q2 and 9% in Q3. This deceleration raises concerns about the company's ability to sustain its growth trajectory. Second is federal spending cuts, a blow to public sector deals. The company's exposure to U.S. government contracts has become a vulnerability. Recent federal budget cuts have disrupted deal closures, impacting revenue forecasts and contributing to a 15% stock drop following the announcement. Third is profitability challenges. GAAP losses persist. Despite reporting a GAAP operating income of $34 million in Q4, UiPath posted a GAAP operating loss of $163 million for the full fiscal year 2025. This ongoing unprofitability under GAAP standards is a red flag for investors seeking stable earnings. Fourth is competitive pressures, rivals gaining ground. UiPath faces stiff competition from tech giants like Microsoft Power Automate and emerging AI solutions. The company's slower growth and challenges in integrating new AI offerings make it harder to maintain a competitive edge. Fifth is stock performance. Significant decline over the year. UiPath's stock has declined by nearly 60% over the past year, underperforming the broader industry. This drop reflects investor skepticism about the company's growth prospects and strategic direction. And make sure to click the link in the description to check out Alpha Picks. This is the best stock picking service, and clicking the link saves you $50 on this awesome service. So go ahead and check out Alpha Picks now and put yourself in the best position to win with stocks.